Okay, let's dive into this. Because today, we're looking at one of the absolutely most fascinating and frankly polarizing situations playing out in the market right now. We are going to unpack the global IT and consulting giant, Accenture. It's a massive market paradox that has institutional and retail investors completely split down the middle. Are we looking at a dangerous value trap here, or is this literally the buying opportunity of the decade? Let's figure it out in today's explainer.
So right off the bat, we're looking at this incredible contrast. On one hand, you've got the unstoppable momentum of the AI revolution, which is, widely considered the biggest technological leap since the dawn of the internet. It's booming. But then on the other hand, you have Accenture's stock, which has just been violently cut nearly in half from its recent highs, dropping over 40% in just the last year. It really begs the question, why the massive disconnect here? Is the market punishing a fundamentally broken business model, or has extreme pessimism completely blinded everyone to the underlying value?
Part 1. State of the business. Let's look at the hard numbers. We're going to start right here with the stock price as of August 17th, sitting glaringly at $169.98. It is hovering dangerously close to its 52-week low of $118. I mean, when a blue-chip titan falls from $291 all the way down to the 160s, you realize just how much institutional capital has simply evaporated. But, when we actually look at the third quarter fundamentals, the story gets a little complicated. The company reported revenues of $18.7 billion. Now, on the surface, that looks pretty solid, right? It's up 6% in US dollars, or about 3% when you adjust for local currency. But here's what you really should take away from this. The market doesn't just care about today's growth. It's obsessed with tomorrow's momentum, and Wall Street absolutely hates deceleration. Accenture actually went ahead and lowered its full-year outlook, projecting revenue growth of just 3% to 4%, and well, that basically just poured fuel on the fire.
So, the crucial point is this. Despite the slower top-line growth, Accenture remains a highly profitable machine. Earnings per share for the quarter came in at $3.80. That's a solid 9% bump year over year. So they're still making serious money, and they are still growing their bottom line. But that profitability just isn't enough to soothe investor anxiety right now. And the next metric explains exactly why.
Okay, here is the absolute most alarming metric for investors right now: new bookings. These represent future contracts, the pipeline, right? And they just fell sharply from a record $22.1 billion in the previous quarter down to $19.3 billion. When you see a sudden drop like this, it strongly suggests that major clients are hitting the brakes and pausing those massive spending initiatives.
Part 2. The bear case. Why exactly the stock is falling. The massive sell-off we've seen isn't just random market noise. It's actually being driven by three major structural and macroeconomic threats that are currently terrifying institutional investors. Let's unpack the true weight of this bear thesis.
First up is the terrifying AI disruption paradox. Historically, companies have paid Accenture millions and millions of dollars to manage massive IT infrastructures or to deploy literal armies of consultants to solve their business problems. But if generative AI can instantly automate legacy coding, handle software testing, and even spit out basic consulting advice, well, the fear is that Accenture's army of consultants might suddenly look like cavalry in the age of tanks. Fewer billable hours and fewer consultants means significantly lower fees, which completely threatens to gut their traditional cash cow services. Second, we have very real, tangible macro headwinds. Management explicitly cited specific geopolitical and government drags that are hurting the business today. They took a direct $100 million revenue hit linked to the conflict in the Middle East. On top of that, they're seeing a really distinct slowdown in their U.S. federal business as government cut-cutting initiatives start to take hold.
And finally, the analyst exodus. We are seeing major institutional downgrades, with heavyweights, we're talking Morgan Stanley, Deutsche Bank, slashing their price targets and downgrading the stock to a hold. And this creates a vicious cycle. When the big institutional analysts tell their ultra-wealthy clients to sit on the sidelines, retail investors usually flee right behind them, driving the price down even further.
Part 3. The bull case. Buying the dip. Could this really be the most extreme market overreaction since 2008? For the long-term folks who are totally ignoring the headline panic, the defense really comes down to three pillars. Let's look at the valuation, the cash flow, and how Accenture might actually be weaponizing the very technology that everyone thinks is going to destroy them. What is really staggering here is this single number, 12.7. That is Accenture's forward price-to-earnings ratio right now.
For a company that has historically dominated its entire sector, this valuation is incredibly cheap. To put that in perspective, their price-to-sales ratio is sitting at 1.5, which is literally almost half of its 5-year average. From a purely historical perspective, this stock is deeply, deeply discounted.
And this brilliantly illustrates what is backing up that cheap valuation: a massive cash flow engine. Accenture boasts an 11.7% free cash flow yield. That means for every $100 you invest, the underlying business is throwing off $11.70 in pure cash. And they aren't just hoarding it either. They are aggressively buying back stock and paying dividends, returning over $2.2 billion to shareholders in the third quarter alone. This cash flow engine is fully intact.
The third bullish point completely reframes the whole AI narrative. CEO Julie Sweet recently came out and stated, "Our AI work is set to double." While the market is terrified that AI will hurt Accenture, the company is actually actively positioning itself as the premier consultant for AI integration. They have major partnerships with OpenAI and Anthropic. Think about it. If you're a legacy Fortune 500 company, you don't have the internal talent to build AI from scratch. You don't buy the parts, you hire the plumbers. And you hire a company exactly like Accenture to do it for you.
Part 4. The Ultimate Catalyst. September 24th, 2026.
If you're watching this situation unfold, this right here is your exact checklist for that upcoming earnings report. Step 1. The revenue beat. Guidance is set between $17.75 billion and $18.4 billion. If they beat this and raise guidance, wow, we could see a massive short squeeze. Step 2. Large deal wins. We really need to see if those delayed massive managed services contracts are finally closing. And Step 3. Actual AI revenue. The market is completely done listening to partnership announcements. Investors need to see actual hard dollars flowing in from AI implementation.
Just look at the sheer uncertainty heading into this catalyst. Analysts are completely split. We have a low target of $130 predicting a further collapse, and a high target of $282 predicting a near total recovery to previous highs. The smart money is completely divided on where the stock goes next, which means this upcoming earnings report is basically everything.
Part 5. The verdict. High risk, high reward. So here's a clear map of actionable strategies based on your own risk tolerance. If you're a conservative investor, the most logical move is the wait-and-see approach. Wait for that September 24th earnings report to actually prove that the growth is returning before you risk your capital. But on the flip side, if you're a long-term value investor who believes the cash flow and fundamentals will absolutely win out over time, this strategy might be to start a small position right now at this historically low 12 PE ratio, just absorbing that short-term volatility for a bigger long-term gain.
Which brings us to the final, most crucial question you have to ask yourself before making any kind of decision. Will AI ultimately kill Accenture by automating away their core business? Or is Accenture the exact company the world is going to rely on to help them adopt AI? The answer to that question will absolutely determine whether this is a trap or the buying opportunity of the decade. Let that provocative thought guide your strategy. Thank you so much for joining me for this explainer, and I really look forward to exploring our next topic with you.